Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, we will be talking about base metals with my guest, Catherine Virga, who is the Director of Research at CPM Group here in New York. Catherine, thank you very much for coming on the show.
Thank you for having me.
So the base metals market, why don't you give us an overview, just sort of a macro picture of how the base metals have been, I suspect, very tied in economically sensitive. How have they been faring?
Sure. Well, you're correct. Base metals, some of them, even like copper, has gotten the nickname for having a PhD in economics because it does closely track economic trends. So we do see a lot of the same, influences from manufacturing, from industrial production, and just consumer trends in general affecting base metal prices. And right now, we're at an interesting, point in time with the economic slowdown in China, which when we talk about base metals, we actually spend most of the time talking about China. That's partly because China consumes somewhere around 40% of many of the base metals that we look at, and for some of the other base metals, some of the more niche ones, it could be even higher. And the economic conditions in Europe with the sovereign debt crisis and the fiscal cliff in the U.S. all keeping base metals a little bit in limbo. We saw a little bit of strength going into the election, but they have pulled back in November and are now at elevated levels comparably to the summer, right. But they're still feeling the pressure from poor manufacturing data and soft construction spending figures and housing prices globally. There are some bright areas, and I'll just talk about some of them. Is really the U.S. The U.S. has been particularly strong. We've seen, fairly, significant rebound in construction spending.
And that's likely to increase based on the Hurricane Sandy, as we do a lot of reconstruction tied into that, correct? In the fourth quarter, maybe the first quarter of next year.
Yeah, this year so far, I think through September, we're up almost 7% year on year. So there has been an improvement after many years of kind of sluggish, performance there, both of residential and non-residential. The auto markets in the States have been particularly strong, and we're also seeing, manufacturing, actually taking the lead comparably to Japan, China, and Europe. We are expecting to see a pickup in the outlook for China, and so that should lend a little support to prices going into 2013. I think we've really kind of reached this trough here for demand, and with the leadership change in China, there are a series of stimulus packages that are slowly being announced, very targeted stimulus packages that could help lend some support going in 2013.
I want to focus a little bit more on the China perspective from the standpoint that there's been some discussion now that China's economy is fundamentally changing. There are policy changes, whereas in the last 20 years or so, we've seen investment-driven economic growth in China, infrastructure, buildings, the types of things that consume large amounts of basic materials. And now Chinese policy is slowly shifting to more of a domestic consumption-based growth model, sort of like what we have here in the United States. Obviously, it's not a thing you flip the switch and it goes the other way. It takes time. But this sets up sort of a question mark, I think, about future demand for raw materials because, the China paradigm, right, has been so strong a factor in commodities because of that investment-driven growth. What happens now if we are seeing a switch over to more of a consumption-based growth? Does that mean, we're peaking out in a lot of these commodities?
Well, no, you bring up a good point. The China's 12th year plan has focused on, really an effort to boost domestic consumption and less focus on the investment led growth. And even right now with the stimulus expenditures, you're not seeing that broad check that was written out in 2009 with that surge in new loan growth. There's very targeted growth, and it's been going to rail, to subway, and helping to build infrastructure and to support domestic consumption. And you're right, we're not going to see that tremendous double-digit growth that we've seen in the past decade. We are calibrating and rebalancing policies in China. And one thing that we'll see particularly affecting resources is the new policies that we expect to see unfold on new resource taxes to help control excess production of metals for the export market that are not, there's no value add, they're not produced into end product. Also, trying to make the power and gas industries more profitable, so they're able to support the growth they need to meet the urbanization trends, and also to meet this domestic consumption that you're talking about. But they have not had the same pricing, which is the free market pricing, which has allowed them to be profitable. And so recalibrating their plans for handling their energy industry will and could raise the cost of production in China and change the dynamics in China comparably to other rest of world producers. China was either employing subsidies or other measures to try to keep cost of production lower, but now with the resource taxes and increased energy costs, we could see growth in other regions of the world which have either more abundant fuel or not. So it's not only affecting demand, it's also affecting supply.
Now, for investors who want to diversify their portfolios, maybe have some exposure to base metals, what particular metals, if any, right now to you stand out as the best bets?
Well, when I talk about base metals, the list goes on, but mostly people talk about the LME traded, the London Metal Exchange traded base metals.
So we're talking about what? Copper, aluminum, tin, lead, zinc, nickel.
Yep. And of that, there's only a few that actually have very tight supply-demand fundamentals. In particular, in that group, it's really copper and tin that are currently in a market deficit. The others might be balanced or in a really deep surplus. So first, we're going to start there. We're going to look at metals that are fundamentally attractive. And then look at the outlook going for 2013. Well, for copper, I think that there are some near-term gains. Maybe not in the last month of December because of the fiscal cliff and the other things that I talked about earlier. But going into 2013, we do expect supply to grow at a swifter rate than demand, at least in the first half of the year. So we could see some decent returns out of copper. Tin is a little bit more volatile, and I wouldn't say for your average investor that's looking to diversify should to go that route.
It's like the pork belly of base metals, we'll call it that, right?
Yeah, no. But I also want to point out that base metals, particularly since the downturn, have been taking a lot of direction from the equity markets and from the dollar and that inverse relationship, and more so than they have historically. So,
but the dollar has been firming up, correct?
Well, the fluctuations in the dollar can sometimes move copper or the other base metals against what the fundamentals would say. So you might see some short-term trading and momentum trading tied to the dollar, which wouldn't necessarily correspond to the fundamentals. But yeah, no, I would definitely, if you're looking at entry points and your investors that have views on equities and they have views on the dollar, timing those up with copper investments would be wise, and to find good points to enter. If you see strength in the dollar, that inverse relationship, you could see a good dip in copper prices. Same for equities. That's a straight correlation.
All right. Well, it sounds like steady as she goes for 2013, right?
Well, it's not that easy. You have to have me back on the show, and I'll take you through 2013.
Absolutely. You have an open invitation. Thank you very much.
Thank you.
Well, that's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.